This is Boroks, and this is my price action trading course module on trading ranges and vacuums. A trading range is an endless pullback. When a pullback grows so long that it loses direction, and when you look at it and you can't tell whether the breakout will be to the upside or the downside, then the pullback has become a trading range. The prior trend is so far into the past, so far to the left of the screen, that it has lost influence over what's going on. For example, if you have a pullback in a bear trend, you'll expect a bear breakout and a resumption of a trend. Pullback is part of a trend. But if the pullback grows for 20 or more bars, the bear will be so far in the past that it will have lost influence over what's currently taking place. Traders will stop using the term pullback and they'll begin to use the term trading range. And the longer the trading range continues, the more likely that the market is totally uncertain. It will break out, has an equal chance of breaking out above as it does below. Here's a bear trend, pretty big bear breakout, possible trending trading range day, upper trading range, possible start of a lower trading range, and at this point we have a pullback. The pullback is growing. Now it's about 20 bars, probably still going to have a bear breakout, but it's getting less clear. We're getting too many bars. Why have the bears been unable to make the market break to the downside? What's going on here? Something's not right. After 20 bars, the bear has not resumed. At this point, 30, 40 bars, the market has lost its direction, and now it's equally likely that we'll get an upside breakout as it is that we'll get a downside breakout. So when you're at the point that you really can't tell which direction is the most likely direction for the breakout, you stop using the term pullback and instead you refer to this as a trading range. This particular trading range ended up breaking out to the upside. There was actually a higher low major trend reversal here. I'll talk about that in a later module. You have a bear trend, a trend line break, sideways for about 10 bars, higher low, and upside breakout. So some traders would start buying in here, hoping that this would result in a major trend reversal. In trading ranges, you're expecting breakouts to fail. Trading ranges are always trying to break out. You'll see sharp moves up to the top. They look like they'll have a lot of follow through and the breakout will be successful. 80% of them will fail. The market will start turning down. It'll race to the bottom, accelerate near the bottom, look like it's going to break out. Beginning traders start to look for shorts. Experienced traders instead start to look to buy because they know that the sell-off, no matter how sharp, is probably going to fail and lead to a reversal back up to the top of the trading range. So you expect reversals back into the trading range, and you should look to fade breakouts. Fade means go against. So if the market's trying to break to the upside, you fade it. You look to short. If it races to the bottom, you look to fade the bear breakout attempt, and you look for reasons to buy. Here's an example of a trading range. Very strong bull spike. Beginners are looking to buy. Experienced traders are looking to sell. Very strong bear trend down for about 15 bars and two very big bars here at the bottom. Beginners are shorting. More experienced traders are looking to buy. So they'll buy above the high of that bar. Again, a very strong bull spike. Looks like we're going to break out. This is going to be a great bull trend. Experts are waiting for the breakout to be confirmed. They're waiting for a breakout and another bar above. Don't get it. Instead, we get a bear reversal bar. Same thing over here. So in trading ranges, the market races to the top, it races to the bottom, only to reverse. So that's, you should be trading it that way. You should expect the breakouts to fail. 80% of them do. Ultimately, you get a successful breakout, but most of the attempts will fail. There's a reason why trading ranges are always trying to break out, and that's because eventually they do. And within the trading range, usually there are bull arguments and bear arguments. The bulls are taking positions looking for a bull breakout. The bears are taking positions looking for a bear breakout. And when the breakout finally occurs, if you look back a little bit into the trading range, you'll see that the trend actually began within the trading range. So within trading ranges, there usually are the beginnings of both bull and bear trends. Eventually one side wins and the other succeeds, but there'll be many attempts by both before the result is known. And when you look back after the breakout, you'll see the start of the trend, and you'll see that it actually was within the trading range. So within the trading range, there is the start of a bull trend and the start of a bear trend. Most of the starts will fail and lead to reversals, but eventually one succeeds. Here's an example. We have a bear trend and then a trading range. And at this point, the bulls see a bear channel, a trend line break, test of the moving average, and a higher low. So at this point, the bulls see a higher low major trend reversal, and hopefully on their part, the start of a bull trend. If the market ended up here instead of down here, traders would look back and say, yeah, this was the bottom, this was the start of the bull, and here's where the trend reversal began at the higher low major trend reversal. So during these bars, the market is in a bull trend. On the other hand, the bears look at the same chart and say, we have a bear trend, and we have a lower high, and now we have a double top bear flag, so we're still in the bear trend. And if the trend ends up down here, which it did, they'll look back and say, oh, this is just a two-legged pullback within a bear trend, and the bulls really did not have much of a chance. So within this trading range, it has the start of a bull trend and the start of a bear trend, or a continuation of the prior bear trend. But during the trading range, if a trading range goes on this many bars, it loses its predictive value, and the breakout can in fact be in either direction. Here's an example, a similar situation. There's a bear trend, there's a tight bear channel and a trend line break, and a lower low major trend reversal, and the bulls tried to reverse up, and we're still in the trading range here. Now it's a broader trading range, it's above this high, and the bears tried to generate a reversal and resumption of the trend. In this case, again, a two-legged pullback in the bear trend. This time the pullback is above the earlier one, but it's still an acceptable formation for the bears, and they had very good selling pressure. Bear bar, bigger bear bar, another bear bar closing on its low, followed by two more bear bars. So for the bears, they see this as a trading range within a bear trend, and they see the continuation of the bear trend at this point. And if the market did in fact trade down, they would say, sure, this is just a rally in the pullback, and in fact the bear trend was, the bears were in control the whole time, and this is clearly the start of the next leg down. However, until that next leg down breaks free of the trading range, it's still within the trading range. So within this trading range, we have a lower low major trend reversal, and we also have a higher low major trend reversal. So the bulls see this as a bull trend. It turns out they eventually were right, and people will look back and say this is the bottom of the bull. However, the reality is, until we started getting this strong bull spike above the top of the trading range, we were still in the trading range, and the bears could have pushed it down. And if they did, they would have said, this is the start of the next leg down in the bear. So within this trading range, there is the start of a bull trend and the start of a resumption of the bear trend, which is usually the case. In trading ranges, usually the bulls and the bears both have arguments, and both are being traded by institutions. There are institutional bears selling here, institutional bulls buying throughout the trading range, and that's why the market's in a trading range. Both the bulls and the bears see it as a good area to initiate positions, And they're both ultimately profitable if they trade this 10 times and manage it correctly. How could the bears possibly be profitable? Well, if they shorted here, they may have taken partial profits here and gotten out break even here. And how could the bulls be profitable? They could have bought anywhere up here, and they could have scaled in here, took partial profits here, and then rode the rest up. And so within a trading range, there are bullish and bearish ways to be profitable if you manage your trades correctly. As individual traders, the best way to trade it is to buy low, sell high, and scalp until there's a breakout. There's often evidence of the direction of the breakout while the trading range is forming. You start looking for series of bull bars. For example, here you get 4 consecutive bull bars. Here we get 4 more bull bars and 3 more bull bars, and the third one has a pretty big body. Here the bears have 4 bear bars, but the bodies are getting smaller and smaller and smaller. So the selling pressure is not as strong as the buying pressure, and that increases the chances for the bull breakout. I discussed this more in the module on pressure. Here we have a market that gapped down and probably became always in long after this strong bull reversal bar, and certainly with this bull breakout with close on high, close near the high, and now even a bigger bull bar. So the market's probably always in long here. It tried to become always in short with the bear breakout, but no follow through, instead a bull reversal. And it entered a trading range. It got raced up to the top and then sold off. Raced up to the top, sold off. You can draw it as a triangle. A triangle is a type of trading range. In this particular case, the bears will argue, well, this is just a lower high. We have a high and a lower high, and now we have another lower high and another lower high, maybe a double top bear flag. So the bears are positioning themselves for the bear breakout. When it gets near the top, they're shorting. The bulls, on the other hand, see a low and a higher low and another higher low and another higher low. So the bulls are looking at the higher lows, the bears are looking at the lower highs, a triangle, and both are positioning themselves for a breakout in their direction. Again, you can look at buying and selling pressure, you can look at always in to make a guess as to which direction is more likely. However, the further the market goes to the right, the more bars we get to the right, the further we are removed from this bull spike, and the less influence the bull spike has on the market, and it increases the chances that the breakout could go in either direction. Okay, strong trends can suddenly reverse. Is it because of something in the news? Television always says that the market turned down today or the market turned up today because of some news event. There are news events taking place every minute, all day long. If the market suddenly breaks out, reporters will look at the current news event and say, that was the reason why the market broke out. And that's not it at all. If you're a TV reporter, you assume that everything that happens in the world is related to the news, because that's what you believe. You believe everything is related to the news. The reality is, most of what takes place in the market is technical, and it has nothing to do with the news. When a very strong trend suddenly reverses, again, it's technical. But you need to know the targets, you need to know the reasons. The market is quickly drawn to support and resistance. They act as magnets. And like any magnet, the closer the market gets to the magnet, the faster it moves. So you start to get bigger and bigger trend bars as the market races toward the magnet. That is the vacuum effect. The vacuum effect of magnets. Support and resistance are magnets, and they quickly draw the market to them. I talk about this in the modules on measured moves, support, and resistance. What are typical support and resistance areas? Magnets. Trend lines are obvious ones. Prior highs and lows. And measured move targets. For example, if you have a trading range, the height of the trading range often leads to a measured move projection where the market will race. Let's say you have an upside breakout from a trading range, the market will race up to a measured move based on the height of the trading range. Let's say you have a strong bear spike, the market will often fall a further number of points equal to the height of the spike. Let's say you have a market moving up and then it suddenly breaks out. That breakout could end up being a measuring gap, and the market may move up to the same number of points above that gap as it took to get to the gap in the first place. Example of a vacuum effect here. Racing to the bottom, reversing up, racing to the bottom, reversing up, racing to the top above a prior high, and reversing down. What was it racing to? Well, here it reversed exactly at a trend line. Here it reversed exactly at a trend channel line. And in fact, this became an expanding triangle. So you have to know what to look for. So I'm always drawing lines and measured move targets because those are magnets and the market often races to them, and then I look to see what the market does at that area. Look at here, the height of this trading range, these pink lines, the bottom of the range, top of the range. Here's the measured move up. The market churned at that area as well. Here's a gap. The high of this bar is above the close of this bar is above the high of this bar. Also, the low of this bar is above the high of this bar. So we have a gap in here. And it could be a measuring gap. So you can look for a measured move based upon the middle of this gap, from the bottom of the move to the middle of this gap. Once the market gets close to the top or the bottom of a trading range, it's within the gravitational field of the edge of the range, and the closer it gets, the stronger the magnetic pull, and the market moves faster and faster and faster as it gets to the top. And it starts going down. When it gets near the bottom, it gets faster and faster, big bear trend bars. And once it gets there, the magnetic pull is turned off and the market's free to reverse. The moves up and down always look strong enough to break out. And traders, beginning traders, will see the market race up and they'll start buying with limit orders as the market's pulling back. Or if it pulls back for a bar or two and starts to turn up in a high one, they'll buy that. They'll only see the bull spike racing to the top. They'll forget all the bars to the left, the trading range. And they'll lose because 80% of these strong breakout attempts fail and the market reverses and then races down to the bottom of the trading range. Again, once the market hits the magnet's turned off and the magnetism disappears, the market usually reverses. Again, the move up or down looks so strong that beginning traders are always looking for a pullback. They want to catch the second leg. They want to be early in the breakout. So if they see the market race to the top and there's a small pullback, they want to buy that pullback because they think that the move up was so strong it has to have a second leg. So they're looking to buy, and they want to make sure that they enter the successful breakout early on. And they get trapped. The market goes up for a bar, forms a small double top, and reverses down. So beginners are always buying at the top and they're selling at the bottom, and that's the exact opposite of what the institutions are doing. And if you're going to make money doing this, you have to be doing what the institutions are doing, not the opposite. Beginners are always trapped into buying high and selling low. So when that market races to the top and it starts to pull back and the beginners are buying, the pullback just keeps growing and growing and growing. And the beginners are wondering, what's going on? I should get a second leg. I'm losing money. And eventually the pullback starts to accelerate as all those early bulls start to dump. The market starts to race down. And the traders with losses are exiting. The market gets vacuumed quickly down to the opposite end of the trading range, the bottom of the trading range, and then the process repeats going up. Strong bull spikes near the top. The bears think the market will go a little higher. So let's say we're right below the top of a trading range and we're starting to race up, but we're not quite there yet. If you're a bear, you see the top of the trading range. You think the market's going to go a little bit higher. So why are you going to short here when you are pretty confident it's going to get here in another bar or two? So the bears stop selling. But once it gets to their target, they start to short heavily. The bulls expect the same thing, and they wait to take profit. So as the market's racing up and it's not quite up to the top of the range, the market's racing up, the bulls aren't going to take profits until it gets up there. Once it gets up there, the bulls sell. They sell to take profits. Once it gets up there, the bears sell. But right before the top of the range, nobody's selling. The bears aren't selling because it's going to go a little higher. The bulls are not selling out of their longs because they know it's going to go a little higher. So when there are no sellers just below the top of the range, the market races up quickly to get to the top. It gets sucked up to the top. It gets vacuumed up to the top of the range. And that's how you get those big bull bars at the top of the range and those big bear bars at the bottom of the range. A strong bear spike near the bottom of the range, the bulls want to buy, right? So as the market's getting down here, the bulls don't want to buy here, they want to buy down here. So the bulls stop buying, so there's no buying by the bulls. The bears are looking for places to take profits. They know it's going to get here, so why would they buy back their shorts here? So the bears stop buying. So once the market gets near the bottom, the bulls are not buying, the bears are not buying, no buyers left, the market crashes very quickly for a bar or two and a big bear trend bar. But once it gets to the target area, the magnet, the support, the bulls buy aggressively, expecting a reversal up. The bears buy aggressively to take profits on their shorts, and then the market reverses. So it gets vacuumed down quickly to support, and then finds buyers. Again, the breakout attempts look strong, but they fail. The market races to the top, races to the bottom, races to the top. So for example here, the bulls who bought in here are looking to take profits. They want to take profits around the prior high, which might be the top of a trading range. So when the market gets right here, those bulls are not willing to sell. They want to wait until it gets up to the top. So the bulls are not selling. The bears also know it's going to get to the top, so they're not going to sell here either. They're going to wait until it gets up here. So with nobody selling, the bulls are not selling, the bears are not selling, the market's going to quickly race up there. But once it gets here, what happens? The bulls say, oh, it reached my target, I'm going to sell out of my longs to take my profits. So the bulls start to sell. The bulls are not buying, they're selling. Once it gets up here, the bears, they start to sell. Top of a trading range, it should go down. So now you got the bulls selling and the bears selling, nobody left to buy. Starts to pull back. Beginners say, oh, I'm going to buy here for another leg up. This leg up was so strong, we're probably going to get a breakout. No, you're probably going to get a reversal because it's a trading range and most breakout attempts fail. Starts to drift to the bottom. The premature bulls have to start exiting. Once we get near the bottom, the market gets vacuumed down. No buyers until we get near the bottom, and then the process reverses. Ultimately, you get a successful breakout. But most of the time, you do not. You get a reversal. Okay, an example near the top of the trading range. Both the bulls and the bears see it as resistance. Once the institutions believe it'll test just a little bit higher, the bears stop selling and wait to short higher. The bulls expect the test and they wait to take profits, sell out of their longs until the market gets a little bit higher. Since both believe the market will get higher, it does not make sense for either of them to sell until the market gets higher. This creates a buy imbalance. Nobody wants to sell yet, so the market races up to a price level where sellers suddenly appear, and it can race up in the form of 1 or 2 or 3 very large bull trend bars. It gets vacuumed up to the resistance level, and then the strong sellers appear out of nowhere. The bulls sell strongly to get out of all their longs. The bears sell strongly to initiate shorts. Nobody's left to buy at this price at the top of the range. The market reverses even though the rally up was extremely strong. The market gets vacuumed down to the bottom of the range, and then the process repeats in the opposite direction, and then the market reverses up. So don't bet on breakouts. You know, the market failed here, it failed here, failed here, failed here. Ultimately, it succeeded. Look at this. You have a breakout attempt, a pullback. It failed. Market went up. Over here, premature bulls thought, "Wow, what a great bull flag. We certainly will get the breakout." Bad trade. You don't want to be buying near the top of a trading range. In a trading range, you want to buy low, sell high, and scalp. So we're high. I don't care that it's strong. We're high. You buy low in a trading range. You don't buy high. Here, you don't sell low. We've been in a trading range for about 10 bars. You don't want to sell low. You only want to buy low. So in fact, a lot of times in a situation like this with a weak sell signal, I'll place a limit order to buy at the low of this bar, and I would get long here. Similarly, up here, top of a trading range, I'm looking to sell. Buy low, sell high. We're high. I want to sell. So I think this is a bad buy, probably a good sell. I'll place a limit order at the high of the prior bar, and I'll get short right here. So in a trading range, you want to buy low, near the bottom, look for reversals, and then near the top, you want to sell. In bear reversal bar, you short. It's better to bet that the breakouts will fail, and you'll be right 80% of the time. Eventually, you'll get a successful breakout. But rather than buying the breakout attempts, it's better to wait to see if the breakout is strong. Wait to see if there's a big bull breakout bar, trend bar, breaking out above the trading range. The context has to be good. It has to make sense that a breakout should be occurring now. You also might want to wait for the bar after the breakout. Let's say we have a bull breakout. Maybe you want to wait until the next bar to make sure it has a bull body, or the bar after that to make sure it has a bull body. You can say, "Well, Al, that's waiting a long time. I'm missing a lot of the move." Yes, but you're paying for that reduced profit. What you're getting in return for that reduced profit is increased probability of success. The move is much more certain. A breakout, it can be a very strong breakout, or it can be a slow transition into a channel. Very often, the market is in a trading range and in a channel at the same time. And the channel traders, the traders who believe the market's transitioning into a trend, will start to position themselves early. Here's a trading range all day long, and then there was an FOMC report at 9:30, and it led to a huge breakout. This bar is actually huge. It's almost a 1% move in 5 minutes. This one bar was enough to flip the market to always in long. Buyers would place stops, protective stops below the low of the bar, and they would buy for a swing, expecting that there would be substantial follow-through from the breakout up. Here we have a trading range, and it broke out to the downside, but it became a bear channel instead of a strong bear breakout. Big swings both ways. At this point, traders are wondering, is it still in a trading range? The whole screen is still in a trading range at that point. The trend traders are betting that it is, and they're shorting strong bull closes, betting that we'll start to get a series of lower highs and lower lows. So it's very common that the market is both in a trading range and in a channel. So this right here, it's a trading range, but low, lower low, lower high, lower high, lower high. Yes, it's a trading range, but it's also beginning to form a bear channel. You can see the module on pressure, breakouts, channels, and the modules on trading breakouts and channels to get information on how to trade when the market looks like this. Buying or selling pressure. All trading ranges eventually break out into trends. There's usually an imbalance between the buying and selling pressure that gives a clue to the direction of the breakout, and it oftentimes allows traders to enter swing trades before the breakout. Remember, in a trading range, buy low, sell high, scalp. Sometimes if you're starting to detect an imbalance between the buying and selling pressure, you might want to take a swing trade in the direction of strength. If the bears look like they're getting stronger, if we're starting to get a lot more selling pressure than buying pressure, even though we're still in the range, you might want to take a short and look to swing it, betting on a successful transition into a bear trend. Okay, the entire screen is a trading range. We went down, we went up and down and up and down, and now we're trying to go up. We went down pretty strong here, we're going up pretty strong here. But take a look at what's going on here. We have 7 consecutive bear bars, very good for the bears, but they were followed by 3 consecutive bull bars, and here 4 consecutive bull bars. So we're starting to transition into buying pressure. And look at this more recent sell-off. This one had 7 consecutive bear bars, but here, how many consecutive strong bear bars do you see? Here's a good bear bar, but the next bar is not a strong bear bar. Here's another bear bar. Next one has a bull body. Here's another bear bar. Next one's a doji. So what's going on here? Why are we no longer getting bear bar, bear bar, bear bar, bear bar, right? We're transitioning. The bear leg is becoming weaker. The bull leg is becoming stronger. So we're starting to transition from selling pressure into buying pressure. So traders are starting to wonder if the bulls are taking over. Look what's happening over here. Look at the low of this bar. We get this bar breaking out. Its close is above this bar. And look at the low of the bar after it. It's above the high of the bar before. This bar, another breakout, close above the high of the bar before. But look at the bar after. The low is above the high of the prior bar. So this is a gap. This is a gap. So not only are we getting a series of bull bars closing near their highs, we're starting to get gaps on the way up. Again, a sign of strength, urgency, buying pressure. So this market looks like it's transitioning into a possible bull trend. So traders might start to buy in here, betting that we're going to get an upside breakout and a swing up. You could always wait for the successful breakout and then buy, but if you see the market transitioning from strong selling pressure into buying pressure, you might want to think about starting to get long early. And this is what took place afterwards. This is what followed, a huge bull trend. The market probably was always in long at this point. By the close of this bar, most traders were thinking, yeah, it's probably going to go higher. And then this bar and this bar, traders are thinking, yeah, look at this, 3 big bull bars following 3 other bull bars. The market's accelerating to the upside. We're breaking out above the top of the trading range. You can see the module on trading strong bull breakouts on how to trade this, but once you know it's always in long, you have to think about buying, even buying at the market, buying the close, buying the close, buying the low of the prior bar, buying a high one. You have to get long. Buying a triangle, 3 pushes down, 1, 2, 3. You have to get long. Even when the chart is in a strong trend, it'll have periods of two-sided tradings. When the periods are brief, it's a pullback and you're expecting the trend to resume. And when it's long, 10, 20, 30 bars, you call it a trading range. To me, any area of two-sided trading is a trading range, even if it's just a single bar. So if you're in a strong bear and you have a 1-bar pullback, that 1 bar is a trading range. It certainly is on a small enough time frame chart. For example, if you're looking at a 60-minute bear trend and you have a 1-bar pullback, that 1-bar pullback has 60 1-minute bars in it. So on the 1-minute chart, it's certainly a trading range. Small trading ranges are pullbacks. Big pullbacks are trading ranges. When you think the market's going to resume, it's a pullback. When you can no longer tell whether the market will resume or reverse, then I use the term trading range. All pullbacks are small trading ranges on the chart that you're viewing, and all trading ranges are pullbacks on higher time frame charts. As long as you think the trend will resume soon, the trading range is a pullback, and you should only trade in the direction of the trend. But once the trading range has lasted so long that it's lost its short-term predictive power, at that point, it's so far from the trend that the trend has lost influence, then I use the term trading range. Uncertainty is the hallmark of a trading range. Whenever you are uncertain whether the market will resume or whether the market will break to the upside or the downside, then the market's in a trading range. Uncertainty is the hallmark of a trading range. Whenever you look at the market and you're confused, the market's in a trading range. Buy low, sell high, scalp. You want to sell near the top, you want to buy near the bottom. Bulls always want the market to go a little bit lower. So when the market's trying to sell off near the bottom of the range, the bulls want it to get lower, but just in case it doesn't, they start to nibble. And a lot of times it doesn't get as low as they want and the market reverses up, right? Bears always want to sell a little higher, so when it gets near the top of the range, they start to nibble into shorts. They start to build into short positions. And a lot of times it never gets quite as high as they want, and then the market reverses down. There are always sellers near the top, pushing the market back toward the middle. There are always buyers near the bottom, pushing it back up toward the middle. And the market ends up spending most of the time in the middle, and very little time near the bottom, and very little time near the top. Prices keep getting pushed back to the middle of the range and spend very little top near the extremes. Why does it not spend time near the extreme? Because near the top, everybody wants to sell. And if everybody wants to sell, the market's going to have a hard time getting up there. At the bottom, everyone wants to buy. If everyone wants to buy, there's not going to be very many people willing to sell down there. It's going to be very difficult for the market to get down there. So you buy low, sell high, and scalp. Right? That's how you trade trading ranges. You scalp, you don't swing, because 80% of the breakout attempts will fail, and most moves will soon reverse back down to your entry price. So if you buy at the bottom looking for a swing, it goes up, it'll come right back down to your entry price. So it makes more sense to buy near the bottom and take profits in the top half of the range, and then look to sell near the top and then take profits on the bottom, in the bottom half of the range. So if you buy near the bottom, the market will trade to the middle and probably all the way to the top. Instead of breaking out, there'll be a sell setup, and then the market will return back to your long entry price. So you don't want to buy down here, watch it go up here, and then watch it come all the way back down to your entry price. You have to take profits. You can't be trading break even repeatedly in a trading range. You got to be doing this to make money. If you sell near the top, the market will trade down far enough to scalp out a profit, and if you don't take your profit, the market's going to come back to your entry price. So you'll end up getting yourself stopped out around break even, and you'll have missed the opportunity to take a profit. So you should be scalping. How can you tell that the day is going to be a trading range day? Very often the very first bar of the day, or the first 2 or 3 bars, or the first 10 bars, will give a sign that trading range behavior is strong and that the day will probably be a trading range day. Trend days often give signs early on that the day will be a trend day. So you got to pay attention to the first bar, the first 2 bars, the first 5 bars, the first 10 bars, and a lot of times you'll see evidence of the kind of day that the day will become. For example, if the first bar of the day is a doji, or if there are several dojis in the first hour, lots of overlapping bars, if it's opening up within a trading range of yesterday, if you have repeated reversals in the first hour, if you have bull bars and then bear bars and bull bars and bear bars, right? All of that is signs that both the bulls and the bears are equally active, and it probably means that the day will be mostly a trading range day. Also, if the moving average is flat, and again, if there is no gap, if today opens right around yesterday's close, if yesterday was a trading range day, and then you can use your personal radar. If you look at the first few bars of the day and you say, wow, I don't know if I should be buying or selling, right? Or if you feel like, oh my God, I got to make money and the market's not giving me a good setup. Those are signs that the day is probably a trading range day. And just relax. Once you know it's a trading range day, you know how to trade it. You buy low, you sell high, you scalp. So here we go. Bear breakout attempt, but a tail. Another bar with a tail. Another bar with a big tail. A breakout attempt, but a doji bar. A big bar here, but a big tail, small body. Sideways, 5, 6, 7 bars, all sideways, small bodies. Many reversals, bear bars, bull bodies, bear bar, bull bodies, bear bar, bull, right? Trading range, price action. So you have to wonder if the day will be a trading range. You see prominent tails, you see reversals, the bars are all sideways, overlapping, and there are no strong gaps. No bars closing below prior. Well, here's a small gap, but it immediately closed on the next bar. This close is below that low. Up here, no gaps. The market went above that bar, but it closed back below its high. So when you look at this, you're probably anxious and confused. That tells you that the day will probably be a trading range day, and so you should look to sell high and buy low. That's the end of the module on trading ranges and vacuums.